So good afternoon. So let me start with where I had left last week. Okay. So last class. So last class I was talking about this commodity derivatives, right? So I explained you what is a commodity derivatives and what are the different instruments which are there in commodity derivatives and all those things. So I think I need to discuss something about the features of commodity derivative market. So there are very important three features which are there, which you need to know when I talk about the commodity derivatives. First one is it's complement to investment in companies than that use commodities. So when I'm putting my investments, I'm doing it in commodities. So that commodities are directly getting traded. So it's not just not investing in a company. I'm directly putting in a commodity. That's a very important factor. So I'm checking its quality. I'm much aware of their standards, specifications, grades, and all those things. So based on that, I'm entering into a future contract for that commodity, particular commodity, irrespective of I'm not thinking of which company I need to put the money with. So unlike in stock market, I'm going by the company and I'm putting the money. Here I'm going by the commodities and I'm putting the money or making my investments in that particular commodities. Second feature is it defines pattern of countries' production and consumption. So, in a larger perspective, if you try to find out the benefits of the commodity derivative segments, right? So, it sets the directions under which the various consumption pattern of the people are getting used to. So, when I'm talking about consumption pattern, naturally it's linked to production again. So, our economy basically we have a huge population, which we call it as a consumption population. Consumption population, where the base of consumers are wide and stretched across the country. So, this is one segment which penetrates into each and every consumers in a wider perspective. So, keeping that in mind, the production and consumption factors, if I need to analyze or if I need to arrive at, then the best indicator or the index is my commodity derivative segments. So, which tells the pattern under which the investors and the suppliers, basically the farmer communities or farmer oriented organizations or farmer producers organization, whatever it may be. So how they are interlinked or interconnected with. Okay, so that's one thing which I come to know, especially the patterns under which the nation's production and consumption happens. I will easily come to know looking at the derivative segments. So I can see the changes taking place in last few years in various commodity exchanges. So what are the main commodities which are getting traded and what are the preferences of the trade which is taking place? Is it agriculture driven or is it the steel or something like that? So what are the commodities through which the demand and supply takes place in the system over a period of time? I can easily make out those things by looking at the pattern of the production and consumption, what happens in the economy. So it's not only for agriculture produce I'm talking about, even I'm talking from the per se of raw materials and the goods which are getting manufactured and distributed and all those things. So it's a more of the broader concept, not only including agriculture, but other aspects also. So gains are the form of price increase and not dividend. So that's what the main thing here is why I do trading in this particular segment is in order to discover price. So the price needs to be discovered through any one of the ways. So I think the sentiments of the market or the investors are one of the areas where we can look at what the price demand is for that particular commodity. So here the concept is more of in derivative markets, the concept is more of arriving at a price, fixing at a price for the future. Okay, so not for gaining any dividends, because we are not putting this in stock or shares. So here it is mainly discovering of the price is a very important criteria. So we want to arrive at a price for the commodities which are more of uncertain in nature. So we don't know what will be the price. So we are arriving at a situation where we need to fix a price. So arrive at a price for the next 3 months or 4 months, or how the contract is drafted. So based on that, we are doing. So that's very important features, 3 important features which you need to bear it in mind. Now let us understand what is the difference between a spot market and a derivative markets. So we know what is a spot market. Spot markets are the present markets which is there. Okay, derivative market is a market which is derived by the underlying asset. So spot market is today prevailing price in the market. So whatever the physical market you see in and around, right, that is the physical market. So that there the prices of that particular commodities are arrived at. That is spot, right? Spot prices are arrived. Okay, so let us see in the eyes of definition and all the regulatory norms and all those things, how these two concepts are different: spot market and derivative markets. That is nothing but your commodity derivatives. So spot market regulators are respective state governments. Okay, the respective state government controls the markets, spot markets. Okay, like your agriculture pricing commission and all those things. APMCs are there. All those government markets are there. So market platforms are there. So government, the respective state government has a control over those spot markets. But when it comes to the commodity derivatives, it is Security Exchange Board of India. Okay, so before that we had FMC, right? Forward Market Commission. I told you about that. So today it is Security Exchange Board of India, which is controlling the regulatory framework of the entire commodity derivatives. But when it comes to the spot market, it is more of the control is by state government. But it operates, most of the transaction operates without the knowledge of state government also. That is one thing. But sometimes the price gets circulated because the support price, whatever the state government gives, right? So that may be taken as a yardstick for fixing the price, and farmers are aware of that. There is a price which is already available in the market, especially given by the state governments. Okay, so through various mechanisms. So that is one thing. Second thing is when it comes to the question of how the trade takes place. So in case of spot market, it takes place between party to party contacts. That is, buyer and seller may be known to each other. So that's the most of the time trade takes place between the contacted peoples, between buyer and sellers who are known to each other. So in spot market, buyers and sellers are known to each other. So I know that there is a buyer in this particular X market. I go and I sell my commodities there to him, and he gives me a price. So this is a continuous arrangement. What happens over a month on month. So whenever I grow some products, or whenever I come with some requirements, I go to that person. I know that he is a supplier. So I go to that supplier and I take the supply from him. So in short, buyers and sellers are known persons in spot markets. But when it comes to the question of exchanges, okay, that is commodity derivatives which are through exchanges, I write a contract and I place it on the exchange, and I don't know who is that buyer. Okay, so buyer who is interested in my contract, he comes to me, and the trade takes place between those two people. So yeah, that means buyer and sellers are not seen each other before the contract gets entered into. So it is between any two parties, wherein the buyers and sellers have not met earlier. Okay, so that is the nature of trades which is there. Nature of contracts. In case of spot contracts, right? It's more of a customized contract. So we both sit together, we both finalize on the contracts, and we both decides, okay, what should be the price and all those things. So it's more of a customized contract where the price is arrived at after where the contracts are entered into after having the negotiations with each other. But in case of exchanges, it is a standardized contract. That means contracts are written and uploaded onto the exchanges by the contract writers. Contract writer can be anyone, buyer or seller. So that means there is a prescribed, standardized way of approaching the market in case of derivative segments. That is commodity derivatives. So that is one very important thing which is there. And since it's a customized contract, we don't know what will happen to the contract after at the time of actually fulfilling the terms of the contract. But in standardized contract, everything is set according to terms and conditions. So there is no question of you getting escaped because of finding some lacunas and loopholes in the contracts and all those things. That cannot happen in case of standardized contracts. But in case of a customized contract, there are chances, there are scopes for both the parties not honoring the contracts on the due dates. So next point is prerequisites. If you ask, is there any prerequisites for spot market? Normally there is no prerequisites. So there is nothing. Only it goes by some agreements on the paper or some assurances and promise by words. That's it. Okay, promises or assurances through oral or through some agreements. So that is the prerequisites. So that is the main thing which is there, where the difference lies between derivative, commodity derivatives and the spot products. So here, in case of commodity derivatives, we have something called as initial margin you need to put. So in order to make sure that you are serious, okay, in terms of entering into the trade, only serious persons will be encouraged to go to trade in the market. So if you are really a serious person, then bring the initial margin. Initial margin will be somewhere around 10% of your contract value. So whatever the contract value or price you are telling, right, 10% of that will be the initial margin. So that margin you need to bring in, so that you need to give them weightage to the contract. Tomorrow simply cannot escape the contract. So in order to honor the contract, you have already paid initial money margin for that. Okay, so that's where the seriousness of the trade becomes possible in case of the commodity derivatives. But this is not there in spot. Spot is just oral communication. Sometimes will be there, oral promises will be there, and sometimes they will put it in an agreement. Okay, so that agreement, we don't know whether that agreement will be properly legally vetted with all the legal requirements and formalities that we don't know whether it will have or not, or it's simply on white paper you are writing or something both parties are signing. So that is a spot market. The next one is type of settlement. In case of spot transactions, physical settlement happens instantaneously or within 11 days of the day. So that is what the terms of settlements which are there normally, which is there. Okay, so it may go beyond 11 days also. Okay, so physical settlements will happen. Physical settlements will happen. That bear it in mind. In spot, physical settlements will happen. Okay, or instantaneously or within 11 days, or it may be some days more than that also. Okay, but in case of commodity derivatives, at the end of the day, there is mark to market settlement in cash, final settlement cash physical at the expiry of the contract. So here there is something called as mark to market. Mark to market is the day-to-day settlement which takes place depending upon the prices on which you have booked your commodities. So you fix some price, right, for entering into the transaction for honoring on that particular day. So any increase or decrease, any gain or loss because of that will be credited to the account of the persons. So naturally, one person lose means it will be debited, and one person gains means it will be credited. So this mark to market is some of the important thing which happens on daily basis. So your accounts get updated with those things, and finally, the final settlement will happen on the expiry day of the contract. So it can be either settled through a cash or a physical delivery. Okay, you can settle either through cash or physical delivery. But in case of spot, it is always physical delivery. So you don't settle through cash there. So you would settle through physical delivery in case of spot. But in case of commodity derivatives, you settle the transaction on the due date. So 3 months henceforth, that's how you write a contract. So on the end of the third month, on the expiry date, whatever the price you have agreed upon, on that day, the settlement happens if it is a cash settlement. Or if you want to take the physical quantity of the goods, the physical quantity of the goods are taken with the settlement amount. So, one thing which you need to know is mark to market is a very important concept. So, when I come to the settlement, I will explain you in detail how this mark to market happens. So, mark to market is basically depending upon the volume of trade which has taken place on that particular transactions in the market. So, whether you are gaining or losing on that particular day. So, if there is a gain, it gets added up. If there is a loss, it gets deducted from you. So, that's the amount what will be there, which we will be losing if there is a loss. So, type of settlements is done, then guarantee of the trade on trust, mutual understanding. So, since this is outside the exchange, this contracts are entered into in case of spot transactions. So the guarantee of the trade is only trust. So I believe in that buyer, you believe in that seller. So both of them believe in each other. That's the trust what they have. So that is the only factor which is there. Mutual understanding is the only factor which is binding them. So today, if someone doesn't honor that trust, or someone does not accept that mutual understanding, they may go to court of law, or they may pick up some quarrel and they can just terminate the contract. All those things happens. But in case of standardized contract, that is not the case. In case of commodity derivatives, there is a clearing corporations which ensures performance guarantee of the contract. So there are clearinghouse agents, we call it as, or clearinghouse companies are there, which have been professionally developed companies under the SEBI guidelines. So they will be working and they will be monitoring the each and every moment of your trade. So what they do, they make sure that whatever you are entering into contract, that doesn't get carried away. So they make sure that whatever the buyer has agreed for, you need to buy that by paying that money, and whatever the seller has agreed that you need to sell that or whatever the agreed price he has talked about. So both should ensure that the commitment towards trade is delivered in such a way that both party gets satisfactory reply. Whether there is a loss or profit, that's a different question. But the contract, whatever they are agreed upon, they need to ensure that the contract gets settled as per the terms and conditions. So that is the responsibility of the clearinghouse corporations. Okay, they play a very important role right from entering the contract stage till the final settlement takes place. Right, they will be there in the loop. So they will be managing the entire the commitment chain, which is there between the buyers and sellers. So that's a very important thing. Okay, which is there, which makes both the parties feel that they are secured. Okay. End of the day, loss or gain is because of the transaction. That's a different question. But at least one person loss, maybe other person gain. That's how the intention or the purpose will be solved. So both parties will be there in the market in order to facilitate those type of things through a custom clearing corporations. They are called as clearing house corporations. Okay, so they will be there. So that is these are the lot of difference between spot and the derivative commodity segments. So spot is something which you see wherever you go to the market, you see people sitting there, right? That is a spot. Okay, that like that there are big trades which takes place. So where person comes, okay, well, I want 500 quintals of these things. Okay, we'll enter into a contract. They are doing it through outside exchange. Okay, that is the spot market. So if they are doing it through an exchange, so your buyer may be sitting in some other place. Okay, here in spot the buyer is next to you, or buyer may be within your city, or buyer may be reachable on phone and he will be entering into contracts. There are n number of ways through which you can enter into contract. But in commodity, we don't know where that person is sitting. He is logging in through your portal and he is accepting, he is quoting for your contracts and all those things. So we don't know where that buyer is there, and there is no face-to-face interaction, or they don't know each other actually till the time they enter into contract. But here, in case of spot, most of the time buyers and sellers are known to each other. Okay, so buyer might have seen the seller, or seller might have seen the buyer, or both of them may be having common understanding with them for a long time. So that's how it works. It works mutually on trust. That's what we told, right? Understanding and trust. So most of the contract happens on that. So we cannot say that it is not a successful model. Okay, there are very good successful spot transactions also. But derivative is something to give opportunities and to bring under control the lot of the exploitation which is to take place. Okay, that they have minimized it through standardized contracts. That's it. Okay, so now let us understand what are the various advantages of commodity derivative markets. So one is price discovery. We are keep on telling this. That is one of the very important objective of the commodity derivative. One is price discovery. So you can arrive at a price because you are entering into a contract today, fixing the price henceforth, that is next 2 months, 3 months down the lane. What would be the price? So based on the demand and supply factors, or based on your various ways of analysis, what you have done in the market, or what is your expectation about the market. So based on those parameters, you are trying to arrive at a price in future. Okay, that means you are discovering the price. Very important thing for commodity market. So at least now I know what will be the price. What will be the price I will be getting 3 months henceforth. So accordingly, I will try to venture into those the commodities only, because if I see that this commodity gives me good price today, so henceforth 3 months I will be selling. I can sell this at 80 rupees. Then I will concentrate on that only. Why I should concentrate on any other product for which I don't know the price? So price discovery through open competition. Okay, so that brings a lot of advantages for me. Okay, what is the next advantage? That is the advantage, hedging price risk. So this is most of the things are based on this problem. I don't know, especially in terms of agriculture commodities, it becomes very difficult to arrive at what will be the price for the current 3 months. So what will be my demand, whether I can recover my cost or not, or I need to suffer huge loss. So as a potential farmer, first and foremost thing is I want to hedge my price. So what I do, I try to go by hedging my price. So hedging the price is minimizing the risk. Okay, minimizing the risk. So how do I minimize the risk? I minimize the risk by going into entering into a contract much in advance before I sow the seeds. So before I sow the seeds, I'm entering into a contract, and that seed should germinate things. Then it should really give me harvest, and after that harvest is done, I will be settling the contract. either physically or in the form of cash. I need to settle the transaction. So at that point of time, so I will be getting a good advantage. At least I know what is the price it will fetch for me in the next 3 months. So I can peacefully try to recover the cost first. Okay, then a little bit of money. So it protects the farmer's interest also. Then investment opportunity. So this is one of the ways. Earlier, I used to either park my money in FDs, post office savings, or in share markets. So I used to put in companies. So now there is an opportunity for me to put in commodities also, which is demanded in huge quantities in over a period of time. So the development of market infrastructure like warehousing, a sailing facility, which is term facilitates pledge financing through warehousing and banks. Okay, so that leads to a lot of investment opportunities. So more the derivative product starts coming into the market, these other areas like warehousing, okay, and infrastructure facilities, all those things also tries to cope up with those changes. So whenever you see any development taking place, right, there are a lot of other niche things which starts developing along with that main development. So it creates investment opportunities in that way. So it flourishes the development of other sectors or other infrastructure facilities which are required for that commodity exchange to perform in a good way. So that infrastructure facilities adds investment opportunities. Then diversifications. Diversification is a very important thing again here. Commodity prices are prone to supply demand dynamics, weather condition, geopolitical tensions, and natural disasters. Accordingly, commodities are an independent asset class and can prove up to be effective means of diversification in one's investment portfolio. See, whenever we go for any investments, okay, the first thing which we need to bear is we need to minimize our risk. So, how do you minimize whatever the investment you are supposed to do, right? Put it in different categories of assets. That is called as asset allocation or portfolio investments. So you go for classification of your investments into different asset categories. So that end of the day, when you consolidate all these things, you can benefit the maximum. Okay, so that's the very important thing which you need to do here. So what do? You go for diversification. So the diversification is something which is very important and relevant. So you just diversify that commodities and into asset class and can prove to be effective means of diversification in one's investment portfolios. So that is possible through this one more segment of or one more instrument called as commodity derivatives. So as the trade prospers and as the business prospers, right, there are a number of other new opportunities which will be available for investors to think of. So that's how we have grown and we have come to so many types of instruments today. Earlier, when investment used to be thought of, right, they used to think of either putting the money in banks or post office. These are the two avenues which are there where people thought that is the safest way of investment. Then they started putting money in insurance also. Then insurance also they thought how much to invest in insurance, because if it covers my life, that's more than enough. Because insurance was only earlier taken as a product for life cover or risk cover. But now you see insurance products also comes with ULIP and all those things where the proceeds what the insurance company gets are again invested in markets. So there are a lot of investment products which are there along with insurance products. So these are the things which slowly started changing, and then came the market, share markets, and different instruments are there in the markets. Now we have bitcoins, all those things. See, there are a lot of things which are coming in the market. Okay, so even derivative commodity is one of the ways of diversification, where you're putting the money in the commodities and not in the companies. That's one more options for you. Okay, where you can try to build your investments. Okay, so that's the different options we have. So what are the disadvantages? Of course, high risk. So since it's a market driven, there is high volatility of derivative exposes them to potential huge loss. So many people have lost money in derivatives because I feel that most of them lost money because not because of derivative segment, they lost because they don't know how derivative segment works. Okay, so the contract, how the contracts have been driven and how it is done, all those things, they need to be a little bit of aware of, and what type of commodity they are putting in money into, and all those things they need to be very familiar with. So if they don't, then they fall into high risk category. Okay, speculative features, of course, markets are driven through speculations itself. Okay, so they go by the speculation. Wherever speculation is there, risk is also there. Okay, that is one thing. Then counterparty risk is not so much here, although go through due diligence. Some contracts traded over the counter do not include a benchmark for due diligence. Thus, there is a possibility of counterparty default. So I don't think this point is now very much effective. Okay, so there is no counterparty risk as such in the commodity derivatives which are through exchanges. So because exchange has taken care of all those plugging points where there used to be a loopholes which used to exist earlier. Now they have filled that loophole. So I don't think there is any what you call the risk factors, counterparty risk, so that on that particular day of the contract to be honored, that person doesn't honor the contract. It's not happening like that. So we mentioned about clearing corporations, right? So they are taking all the KYC related things and all those things. They are doing it. So chances are very less, okay, nowadays. So let us now try to find out what is the difference between equity derivative and a commodity derivative. So this is one of the things which is most commonly thought of, because when I want to go for investment, right, I want to compare myself. How good it is if I can put it in equity, or how good it is because I want to put it in commodities. Because don't be of the impression that all the investors who are putting money in commodity derivatives are the people who want to do that business in commodities. No, they don't. Many of them don't do the business. There are few people who buy that commodity in physical and they do trading in that. That's a different category. But majority of the people, they want to take the advantages of the market, demand and supply situation and volatility, what prevails in the market. They want to take that advantage and they enter into contract. So those are the people who don't take the physical delivery of the goods. They only take the physical cash related settlement process. Okay, they don't do the physical acceptance of the goods. So in commodity derivative segment, one thing is, first one is underlining assets. What we talk about is a physical asset, but here it is a financial asset in equity derivatives. So in case of markets spread across the country with major trading concentration in major production consumption centers. So this commodity derivative markets, right, they have spread across the country. But in equity derivative, it is through electronic national level stock exchanges only. Okay. So it is happening on the screen-based platform only, but there is no commodity, physical commodities which are available. It's through screen-based electronic transactions which takes place in case of equity derivatives. So commodity derivatives, a lot of times it is uncertain, it is estimated, basically estimated, because it's a future contracts what you are entering into today. So uncertainty is more in case of this derivative products, derivative commodity derivative contracts. But in equity contract, it's certain, available in public domain, because everything is published. Index is there, a number of shares are there, market capitalization is there, everything, all information about that particular company share is already available. So equity segment investment, you have the physical appearance of all the what is the volume of shares available, what is the price at which it is getting traded, what is the highest close, lowest close, everything is available, okay, in case of financial assets. But it is not there in case of this one, because it's spread across the country with major trading concentrated in major production and consumption centers. So uncertainty is high in case of the, the derivative commodity contracts, but uncertainty is limited in case of the financial assets contract, that is equity contracts. So the major participants in case of commodity markets are farmers, traders, manufacturers, brokers, FPOs, etc. So they are in turn they are the traders. They buy from here and they go into another market and they sell them. So basically, they are traders, farmers who are entered into in case of commodity markets. There can be other people also, like you and me, also can go and trade, even though we are not famous farmers and traders. We can still trade in commodity derivatives. But in case of financial assets, it can be anything. Okay, you can be trader, I can be trader, or any institution can be trader, any retail person can be trader. Anyone can be the trader in financial assets. Settlement is in case of commodity settlements, it happens through physically handed goods, warehouse, vaults, other storage infrastructure required, electronic warehouse, vault receipts are issued for goods held in isolated storage locations. So, in case there is a physical handling of goods also in case of commodity derivative. Here, there is nothing called as physical transfer. It is only through Demat account. Okay, the money will be transferred to your Demat account, and the settlement will happen through the Demat account itself. So, money is the transaction which gets traded here. Okay. Then coming back to the weather direct effects on commodity. Okay, so if there is a weather change, then it will have an impact, or climate or weather or any natural resource disaster, right? It will have direct impact on the commodities. But such type of things doesn't impact directly. Only thing is the performance of the company which is doing such type of business will be impacted. And if you have put the money in such companies, right, the shares may get impacted. But there is no direct impact. It's only the indirect effect which will be there on that. Okay, so but any climate change, any environmental related issue, anything happens, right? The first thing is commodity gets impacted because of that. There will be a direct impact on the commodity. But in case of the financial markets, it is indirect effect which will be there. So, what are the nature of commodities that can be traded in commodity derivatives? First one is storage and durability. So, these are the various futures which are there. So, one is it should be a commodity which has a potential of having a good storage and durability. So, commodity should be durable with storage possibility, since it provides a hedge against price risk for the carrier of stocks. Then homogeneous. So whatever the units you are getting traded, it should be homogeneous so that the commodities are actually derived in a derivative market. So it should be homogeneous. Price fluctuation. The commodity must be subject to frequent price fluctuation with wide amplitude. Supply and demand must be large since it creates greater avenues for trading in commodity derivatives. So price fluctuations should be good. Cash market race, supply must flow naturally to market, and there must be breakdowns in an existing pattern of forward contracting. This indicates that cash market risk must be present for commodity derivative markets to come into existence. If the price fluctuation are eliminated using a cash flow of forward contract, the commodity could be limited use only. See, why people will invest in the market? Why people will? Because they want to gain something, right? They want to get dollars. Why do they take risk in putting the money in the markets? They are taking risk because they want to take the advantages of changes which has taken place in the market. The changes which takes place at the volatile level which takes place, right? In order to gain that advantage, people are entering into the market. Okay, so that's the intention of why the people win. That is cash market risk. That's called as. So, who are the different types of people who are there in the markets? That's a very important thing. There are basically two important players who are there in commodity markets. One is risk givers, and the other one is risk takers. So, who are the risk givers? Risk givers are those people who want to who are writing a contract for their products or commodities. So they are called as hedgers. Okay, risk takers are called as investors. So I am a risk taker. If I want to put my money in commodity market, I am a risk taker. So I am an investor. So who is an hedger? Hedger is a person who is writing a contract who wants to sell his commodity. So he's a risk giver. He is giving the risk to you. Because tomorrow, what happens to the price, you need to take that hit. Whether if there is a good prospects which happens in favor of you, then you gain. You are not taking any risk there. Okay, so you gain. But at the time of entering into the contract, we don't know who are the people who will be taking. So risk is attached, prefixed for both risk takers or risk givers. For both of them, risk is prefixed because we don't know in this transaction who will be the person who gains and who will be the person who loses. So at the time of entering into contract, both may be a risk taking person only because we don't know how the market moves in the next 3 months. Okay, so hedger is a person who is who is represented by manufacturer, traders, farmers, all those people. So what is the objective of the hedger? Hedger objective is to reduce risk due to price fluctuation in the spot market. So if I go to the spot market, there is always a price fluctuation. I told you, right, in types of commodities, especially agriculture commodities, right? Unless and until you go to the market, you don't know what will be the price. Example, oil, cotton seeds, if you are taking those things, right? Unless and until you go to the market, you don't know what the price is for that product on that particular day. So when you carry all those things and if you see that price has fallen, then there is no other option. You cannot bring back that good commodity to your house back. You cannot ship back that commodity and say, I'll go after 1 month. Because there are a lot of durability factor which is there. Okay, the product may lose its significance or value over a period of time, or it may lose its vegetables, let us say vegetables like things. It may lose its value, right? So the durability is there. Cotton and all, you cannot again bring back and store it in a place and take back after 1 month when the price goes up and all. You can't do that. Okay, but now serious efforts have been made in order to bring that freezer facilities, refrigeration centers, okay, upgrade the warehouses and keep the commodities there, store the commodities, give it at a price when it comes. So the efforts have been made, but more people start storing the commodities at that point of time. I don't think the demand will again go up in such cases. So there are a number of ways today where the market is getting connected. So if people grow cotton and if they don't bring it to the market, there are other ways where the cotton can be imported from. So again, this will act as will not create a good market for the products what you have sold stored in your place. So there are things today in business. There are a lot of things which are happening around. So to reduce risk due to price fluctuation in the spot market, I enter into this. I hedge myself. I take the risk. I take the risk, and I want to cover that risk. That's very important. So hedging is the way you cover the risk. You know that there is a possibility of risk, and how do you cover that risk? To write a contract and enter into a future agreements. That's how you try to cover yourself. So if price goes up on that particular day, then you will lose. Okay, so you could have taken the advantage of selling that in the market and making money out of it. So it depends on how you write. So hedging implies taking position in the future market that is equal and opposite to the physical market position, such that the overall net market risk is reduced or eliminated. So that's my intention. I want to be on the safer side. So I want to get my cost and little bit of margin back. So for that, I enter into derivative future contracts. So in case of financial investors, the objective is to anticipate the future price movement and take suitable position in the future market with an intent to make a profit. So my objective is very clear here. So I'm not going for any hedging here. Okay, my intention is to make profit. So like that, either I can be a investor or I can be a trader. If I want to take risk, I will become a trader. If I don't want to take, I'll put some money in my some few stocks and I'll keep quiet. So let the market run on its own. So I will see the market position after 6 months, 8 months, 1 year. So it's an investment what I've done. So I'll wait till 1 year and see whether I've made some profits out of that investments or not. So I'm taking a risk in that way. Okay, as a trader, I'm taking a risk in a different way. As an investor, I'll be taking a risk in a different way. So what is the final implication of financial investors? Willingly accept price risk in order to profit from the price change. So I'm ready to take some gains in the market. So the position depends upon whether I'm a trader or an investor. If I'm a trader, definitely I'm looking for a short-term gains. So I may lose there. But as an investor, over a period of time, I may wait and I may gain there because I put the money in different portfolio depending upon the changes. So I have a time for to put that money, see that the money grows over a period of time. Okay. Then we have something called as arbitrages. Arbitrages are there in all markets, commodity market, financial market, everywhere you see. So their job is to make money within a short span of time without taking any ownership of that particular assets. So before the close of day of the trading, they change the hands. So they are the people who will be just entering into contract and immediately entering into selling contract and make money out of it by looking at how the markets are behaving. So their intention is not trading also, their intention is not investing also. Their intention is to take the advantage of the markets. Okay, so the movement, whatever is seen in the market, right? They want to take that advantage, that particular small advantage, and in that small advantage, they want to make money out of it, or sometimes they lose money out of it also. So they earn riskless profit by buying and selling in different markets at the same time to profit from price discrepancies. So only because of that small change in price, right? They want to make that money. So they are called as arbitrators. So we have hedgers, we have investors, and we have arbitrators. So they are the people who are there. So who are the regulatories? We have already discussed on that. SEBI is the regulatory of all your commodity derivatives. So prior to 2015 September, it was Forward Market Commission. FMC was there. So after 2015, FMC was merged with SEBI. So today, SEBI is the regulator for all your derivative commodities. So why you think regulations are required means regulation is required to ensure that the fairness and transparency in trading, clearing, settlement, and management of the market institution, including stock exchanges, clearing corporations, and broking houses, and also maintain integrity of marketplace so as to protect and promote the interest of various stakeholders and investors. See, naturally, what happens? The role of regulator is it works for both buyers and sellers, or various people who are there. Okay, like clearinghouse agents are there. There are settlement boards are there. There are a lot of broking firms are there who are there. So the regulator works for all these people. Okay, it's not only for buyers and sellers; it's all the stakeholders who are there in the market, right? So the ultimate objective of this derivative market regulator is to see that there is fairness and transparencies, okay, in the entire market, so that there should be a trustworthy place for people to believe and put their money. Okay, so that type of environment, conducive environment, needs to be created, and that's the objective of a regulator. Regulator needs to ensure that that trade takes place in a fair and transparent way, and also to make sure that each of the parties who are associated with the markets are also do their job, okay, what they are expected to do. So that's the ultimate objective of the regulators. So that regulators do the same thing even in the commodity derivative segments also. Okay, so that is those things. So what are the types of commodity traded in commodity derivative markets? If you ask, one is agriculture commodities. So we have discussed in detail. Bullion and gems are also one of the important commodities which are traded. Energy commodities, we have already discussed on that, natural gas, crude oil, all these things. Metal commodities, other than your gold and we don't consider gold and precious metal as metals. So here, when we talk about metal, we talk about brass, iron, steel, copper, and all those things, all the basic metals. So this is what the entire commodity derivative market is all about. So so we have completed the concept of what is derivative markets, commodity derivative markets. So in our next class, we'll be going and studying something about the settlement processes. Okay, what are the various settlement processes which are there, how to do the settlements, and what are the role of a warehouse. So all those things we'll see those things in our next class. Okay, so thank you for your patience listening. So if you have any questions, you can ask, or you can put for the questions in the chat box also. Okay, or else we can discuss, we can take up those questions in the next class. So any questions? If you have any questions, please post those questions. So do you have any questions on today's class about derivatives, commodity derivatives? So we just discussed about the markets, okay, commodity derivative markets. So that brings to an end our commodity derivative market segments. So next thing is we need to go for our settlement process, trading and settlement, how the trading takes place, what are the settlement process. So there are a lot of things to know in that. Okay, so we'll discuss those things in our next class. Thank you. Thank you.